Hi everybody, Dana Sparks, broker of Maximum One Greater Atlanta Realtors, and today's contract tip has to do with the financing contingency and the appraisal contingency, and just a little bit of basic discussion about those two and the differences between those two. So let's just dive in, shall we? First of all, just even though a buyer's financing and appraisal are related, if a buyer is getting a loan, per the contract, the appraisal contingency and the financing contingency are two completely separate contingencies. In essence, just a general global way of thinking about this is the financing contingency is the lender's assessment of how much they think or how confident they are that the buyer is going to pay the lender back for the money they loan out. So that has to do with the buyer, him or herself, their credit score, their history of paying back loans, how much outstanding debt they have, their debt to income ratio, how much money they have in the bank or in reserves, so forth and so on. So a financing contingency is a lender's risk assessment of the person paying them back. The appraisal contingency is, in essence, a risk assessment of the property that they are lending the money on, the collateral for which they will get back if the buyer does not pay them back. In other words, is the property in and of itself going to get enough money on the market, should they have to sell it, to cover the money that they lent out to the borrower who never paid them back? So again, the financing contingency has to do with the person, the borrower. The appraisal contingency has to do with the property. It's an assessment of the property versus, and the financing is an assessment of the person. Two completely separate issues. And the reason I am discussing this is that we have been seeing, for whatever reason, a lot of contracts coming across, and in the discussions between the agents, the buyer's agent is saying, we need to extend the financing contingency because the appraisal hasn't been done yet. Well, they're two completely separate things. You don't need to, a seller does not need to agree to an extension of a financing contingency because of an appraisal. A buyer cannot terminate based on a financing contingency protection if the property does not appraise. Likewise, a buyer cannot terminate protect their earnest money under an appraisal contingency protection if the lender is not going to lend them the money. They're two completely separate contingencies, and you don't have to have one without the other. Now, a lender more than likely is going to require an appraisal, but a buyer doesn't necessarily have to make their property contingent upon the property appraising for sale price. As a matter of fact, in this competitive market, we're seeing a lot of buyers willing to pay cash over the appraisal. So the appraisal contingency really is of no consequence to the contract. So why does this get confusing? Well, it gets confusing because in the GAR contract package, GAR has the appraisal contingency and the financing contingency contained on one form on the loan contingency exhibits, even though they are two completely separate issues or contingencies. So in the GAR form, for example, on the GAR, Georgia Association of Realtors Conventional Loan Contingency Exhibit, which is F404, the financing contingency timeframe is filled in on paragraph 5, and then the appraisal contingency timeframe is filled in on paragraph 11. Now, let me stick with GAR for a minute. Again, GAR, for whatever reason, has put both of these two completely separate contractual contingencies on one form, but they are different. In the FHA loan exhibit in GAR, which is F407, the the buyer's financing contingency timeframe is negotiated in paragraph 5, but in an FHA loan and in a VA loan, there is no fill in the blank for a time frame for an appraisal contingency. So in the FHA loan exhibit under GAR is F407, and for the VA, which is it is the GAR form F410. Same thing, the financing contingency time frame is paragraph 5, and in both of those, the appraisal contingency, in essence, is paragraph 11, which is the amendatory clause paragraph. And you'll notice there is no time frame in there. A buyer who is getting an FHA insured loan or a VA insured loan, their earnest money is protected should the property not appraise through day of closing, through the entire time frame of the contract, because there is no date. Now, in the RE forms, the appraisal contingency, that is true for FHA, that is true for VA and FHA. That is true regardless if the parties are binding using a Georgia Association of Realtors contract or an RE forms contract. But if the buyer and seller go binding under the RE forms, the contingency timeframes are actually filled out in the actual purchase and sale agreement, which is RE 100. And it is under paragraph 6, which is where all the contingencies are. Paragraph 6.2 is the appraisal contingency timeframe, and paragraph 6.3 is the financing contingency timeframe. So buyer and seller negotiate days from binding agreement date for a financing contingency that the seller gives the buyer so many days from binding agreement date to convince a lender to lend them the money, that they are worthy of the loan and they do have the means and can prove that they will pay that loan back. If they can't do that, then they have to terminate the contract with proof from the lender and send notice of that proof prior to that time frame. And for the appraisal contingency, that means the appraiser must go out, appraise the property, and make an assessment and do a report that the property is going to be enough collateral for the money the lender is lending out, should they get it back and have to sell it and recoup their money that way, rather than the borrower paying them back if it goes under foreclosure. So again, I just wanted to let you guys know a couple things. Number one, they are two completely separate contingencies, even though contractually they are located on the same form in GAR. Additionally, don't leave that blank. You should never leave any blanks in a contract. You should put 0 or not applicable, 0 days from binding agreement date or not applicable. If it is left blank, then just like the appraisal contingency on FHA or VA, if it is left blank, then that buyer's contingency would go throughout the entire term of the contract. In other words, through day of closing. And basically what it says in the GAR form, for example, on the conventional contingency loan exhibit, it says buyer shall have blank number of days from the binding agreement date to determine if the buyer has the ability to obtain the loan described above. And then it goes on and on and on. So if that, and we're seeing anywhere from 14 days, 21 days, 28 days, it depends on the negotiations between the buyer and the seller, the property type, the lender, how far along in the process that buyer is before writing the offer, so forth and so on. But if that is left blank, then it would read, buyer shall have from the binding agreement date to determine. If there's no time frame, the time frame goes, it is a contingency with the contract. So it would go the entire length of the contract, meaning through the last day of closing. One other point. So if you're a buyer's agent, I still would not leave. I can't encourage anybody to leave any blanks. But if you're a listing agent and you get an offer with a loan contingency and that time frame is left blank, the seller is probably going to want to make a counteroffer back, putting in a certain number of days to limit the buyer's time frame to find out if they are going to get their loan from a lender or not. Look how cute this baby is. If the other thing I want to bring to your attention is there has been also some confusion on an extension of a closing date. If a buyer and a seller agree to extend a closing date, then a financing contingency or any other contingency is not automatically extended. Well, I take that back. There are only two contingencies that would be extended with the extension of a closing date, and that would be the appraisal contingency on an FHA insured loan and an appraisal contingency on a VA insured loan. But all other contingencies are not automatically extended with a signed agreed upon extension of a closing date between the buyer and the seller. Financing contingency, it doesn't get extended. Sale or lease contingency doesn't get extended, or any other contingency that the parties agree on in the contract do not automatically get extended with an extension of a closing date. So I hope this contract tip helped clarify a little bit of some confusion between financing and appraisal contingencies. Again, they are two completely separate contingencies. And for example, if a buyer says, I need to extend my financing contingency because the appraisal hasn't been done, well, no, you would just extend the appraisal contingency if the seller agrees. There's no need to extend the financing contingency because if the appraisal comes in lower than the contract sale price, a buyer can't terminate based on a financing contingency timeframe and get them protect their earnest money based on an appraisal issue. Those are, again, two completely separate assessments of the parts of the contract by the lender. Hope this contract tip helped you out. Dana Sparks, broker of Maximum One Greater Atlanta Realtors, satisfying your needs with service, innovation, and education. Hey. Hey, Seema.